Welcome, everyone, to the Family Firm Investment Call. I'm Nate Gendelman, the president and for joining us. We realize that 2016 has gotten off to a rocky start. And in fact, there's been a great deal of volatility in the markets for just about 6 months now. So during this call, I'll share my thoughts on a framework for considering what's been causing the market gyrations, as well as some rather purposely vague predictions as to what might happen next, along with some reasons for optimism. For the first segment of the call, what we're going to just do is mute the phone line just to make it easier for everyone to hear and to reduce background noise. And after my remarks, we'll open up the lines and look forward to any questions you might have. Some people also emailed in some questions, so that's great. I'll just let you know, we'll send out an email about this later, but our plan is to make a recorded version of the call available on our website, and we'll try to send out information about that as well. So basically, my kind of theme for this, and just kind of my framework for trying to understand what's going on, is just what I call uncertainty versus certainty. Uncertainty is always with us, and it's actually an essential part of investing. Investors always, whether they admit it or not, have uncertainty regarding their predictions about the future. And as we all know from our own lives and experiences, the future never quite comes out the way we thought it would. And truly, much the same holds in the markets and in the financial world. Investors' expectations and predictions are always evolving and changing as the environment changes and evolves. I think it's probably safe to say that investors prefer more certainty than less. Clearly, most investors would prefer, let's say, an investment that is guaranteed to produce 8% a year versus one that has a wide range of possible outcomes, including maybe losing everything, but still has that expected return of 8%. So I do think it's safe to say most would prefer the guaranteed. And actually, most of financial theory is based on that concept, that investors prefer certainty and will shy away from uncertainty when possible. So anyway, why am I talking about this? Why is this concept particularly relevant today? And how can it help explain the gyrations with more downs than ups over the past 6 months or so? Well, I think simply put, it's because uncertainty has climbed dramatically recently. And also, let me just please reiterate that there will always be uncertainty involved in economics and finance, and it's inescapable. And even during the extremely strong stock market that we had for over 6 years, uncertainty was always present in one form or another. But, and I think this is crucial, there was certainty, or at least a very firm consensus, on several specific things that really helped create and maintain the strong bull market that was experienced. According to my thoughts and evaluation, there were 3 specific factors that investors felt were vital and had great certainty about. Number 1, Federal Reserve policymakers were able to evaluate conditions and dial up the correct policies to keep the economy going. And even more importantly, from the investor's perspective, those policies kept asset prices high, kept stock prices high in other assets. The number 2 factor that I think people felt a lot of certainty about, that the actual aim of what the Fed was trying to do was to keep asset prices high. They thought that was the intention. And I would say number 3 that I think people felt a lot of confidence about was that China's technocratic decision makers would continue to make sound decisions, as they had for so many years, to continue to integrate China into the world financial and economic system. And what I would offer is that in recent months, all of those quote-unquote certainties have faded to become more and more fraught with risk and uncertainty And I think in this light, the high level of volatility we've experienced in the past 6 months is readily explainable and explained. To briefly summarize what I think has happened with each of those three, the first being the Fed's ability to evaluate conditions and prescribe a cure. What we've seen is kind of a continual dithering about whether or not to raise interest rates. Certainly that did not inspire any confidence. Then the decision to actually begin raising rates just as the economy was beginning to slow and energy prices were tumbling is kind of a head scratcher to many investors and does call into question that ability to steer the economy through. The second assumption that I had mentioned was that the aim of the Fed was to keep asset prices and stock prices high. And I think you'd have to maybe reconsider that, because as they certainly seem to be making their public pronouncements that their goal was to raise interest rates 4 times in 2016, that seemed to send a pretty strong signal that they were willing to let prices drop to fulfill their other responsibilities to however they perceive them to be. And the third kind of pillar of certainty that I'd mentioned was China. And I do think it's been demonstrated fairly often in recent months that China's financial regulatory framework is not up to the task. So whether it's restrictions on stock sales, shutting down the markets when the prices went down, or just confused and confusing signals about the currency level, the Chinese decision-making at the highest level, it's been exposed as much less technocratic and skilled than had been assumed. So with these, again, quote-unquote certainties reduced to something that might better be described as ulcer-inducing, we've seen the markets wobble and stagger. And I do think this is interesting, is that with all this injection of uncertainty, there have been quite a few positive developments that honestly have just been completely overlooked or pushed to the side. And just some of them would be just the huge drop in oil and other commodity prices, which is a net positive for most countries, most industries, and most consumers. Another very strong positive is the job market. Hundreds of thousands of people each month finding work, and yet with no inflationary pressures at all. Hard to ask for much more than that. Profit margins are just below record highs. They would be at record highs if it wasn't for the oil companies taking a hit. Also going on throughout the world is Europe is undergoing a gradual recovery from some of their crises. And one more positive is that whether 100% effective or not, central banks throughout the world continue to be very active in doing what they can to promote economic growth. So a lot of positive things going on, but I do think they've just been overwhelmed by some of the uncertainties. So that's my look at today and the past few months. And what about tomorrow? And as I said, some purposely vague descriptions of the future. And I really just think that there's really 4 possible outcomes that can result from where we are today. And the first being, and actually I think this is the most likely, is that positive steps are taken by the Fed and or China just to reassure investors and to diminish uncertainty about the efficacy and just the intent of their actions. I do think that's the most likely outcome and would probably be considered quite favorable in the markets. The second potential outcome, and I think this one is the least likely, is that the Fed and or China takes intentional steps that impede or damage the investor environment. So basically a complete reversal of what they've been trying to do. As I said, that's probably the least likely. I have a third possible outcome, and that's just kind of a continuation of this uncertainty such as we've seen. We have a lot of sharp swings in the sentiment of the markets, although probably the economic facts would gradually assume more importance And at some point, the positive or even the negative economic developments would be more appreciated and recognized by the markets, and that asset prices would correspond to what was happening in the economy. And even a fourth potential from here is that we just have another crisis du jour. It could be, we've had so many. We had the government shutdown drama. We've had the Greek debt crisis. I don't want to list them all. And again, that something of this nature will occur, even in the near future. It does seem inevitable. However, it's true that it's been the case over recent years that these have all proved very transitory, and basically their main impact was to provide portfolio rebalancing opportunities. Nothing more than that. And I would just say, just to summarize, in trying to look ahead, that we just have to admit that no one can know when the uncertainty will lift, and investors will feel more confident to participate in the market and push prices up. As I noted above, the increase in confidence and diminishment of uncertainty seems the most likely scenario, but uncertainty and risk will always be with us, and it will remain an integral part of investing. And as I think I know many of the folks on the call have been with me and the family firm for many, many years, and they know that it's because of uncertainty and that we can't tell what's going to happen and when, that we always remain diversified. If we knew it was going to happen, we would not have to be diversified, but we don't, and no one else does. So with that, I would be thrilled to hear your thoughts and questions, and we will open up the floor.
Hey, this is Rick. Nate, Rick.
Oh, hi, Rick. How are you?
May I ask a question?
Please.
I know ourselves, and I think as you've alluded, the family firm's objectives pretty much fall along the line of wealth preservation as a #1 goal. At this stage in the declining market, do you still feel that you're achieving that pathway well?
I would say yes, although I would note that different clients have different objectives in terms of where they are in their lives and how much, risk or drawdown they could experience.
Sure.
I think that what we consider the cornerstone of our process is that the investments are integrated with the planning, so that what we try to ensure is that no one is facing such an undue amount of risk that a market decline would sink their financial plan, for lack of a better word. And I think even during the bad years of 2008 and 2009, I think where the markets were down 40 or 50%, I think that proved itself, and certainly through what we've been experiencing recently, where the declines might be in the order of 10 to 15% in the market, with some numbers plus or minus from there and some of the other asset classes, that has still been achieved across our clients. And one thing that's definitely helped out in that regard, as well as we've seen the stocks wobble and fall, again, similar to many of the other crises that we've had, mini or major, is that the bonds have moved in the opposite direction. To some extent, real estate has moved in the opposite direction. And that's really helped to provide a lot of ballast to portfolios, even those that are targeted for growth. And that's definitely helped, definitely keep things together and helped us to avoid what we always are striving to avoid, which would be to sell stocks at a low point. And that is true across the family firm portfolios, that no one has had to sell stocks that didn't want to. And that's usually the key to holding things together. Did anyone else have a question that they wanted to throw out for, or just something that they wanted their peers to think about as well?
This is Alfonso Nat. I just have a quick question for you.
Sure, Alfonso.
Can you comment on the impact of oil prices in all these situations, and what is your best perception of this going forward?
Thanks. Great question. I'm sure that's on a lot of people's minds. Just to rephrase, but just to kind of repeat the question, because it might have been difficult for everyone to hear. I think it was just about the effect of the oil prices and, you know, what might be happening from here.
Yes.
So I will say it's been kind of interesting because what we've, you know, there's kind of been an evolution of thought to where it seems like the commentary these days is that high oil prices are good for the stock market and low oil prices are bad, which I'm not quite sure how that developed, but it's been kind of an interesting development over the past few months. And it's kind of, I would just say interesting because it really sort of flies in the face of logic. And I was just chatting about that, actually not that long ago with Stacy, just a few minutes ago, as a matter of fact. And, you know, we're talking about, oh, a barrel of oil used to be 100, now it's 30. Oh, gosh, that's terrible. And the stock market has gone down in response. And it's kind of an interesting mind game to say, well, what if it had gone the other way? What if it had gone from 100 to 300? Would the stock market be doing great and everybody say how great that is? I think that one sounds worse, right? So, you know, I think really if you look at what's kind of gone on, I would just sort of say that the two aren't related to each other. Maybe they happen to be happening at the same time, but the situation with oil is that there's a lot of capacity, there's a lot of countries that are producing oil, and every one of them has decided it's in their best interest to produce as much as they can. So there is no more OPEC, they gave up, and there's all these other producers that are non-OPEC, and whether it's Venezuela or North Dakota or the oil sands or Saudi Arabia, they've all decided that it's in their best interest to pump as much as they can. So even though oil demand in the world is increasing, which it is, this year will increase more than it did last year, which is more than it did in 2014, with every country producing as much as they can, the prices have come way down. That's a good thing. And maybe simultaneously with this, some of these other things are going on in the world, which have people a little spooked. But I'm not convinced that one is causing the other. And it could very well be, as has been the case really for the past 50 so years, that when oil prices have come down, it's led to an increase in economic activity. When oil prices have shot up, it's led to a recession, basically every time since 1970. And as we sit here today, I don't see a reason that that should be any different this time. So I do think, you know, in some of the noise of the over attention being paid to China's currency and what's the discount rate on the Federal Reserve, when some of that dissipates a little bit, there'll be a little bit more recognition that, oh yeah, cutting the price of a major input to our economy going down by 60 or 70% is probably a good thing.
Right.
Overall.
Okay.
Thank you.
Thank you.
Nate, this is Carl. We are diversified, and we are in a situation where we don't want to risk any more than we have to, although I'm sure everybody feels that way. Should we start thinking about going towards bonds, or is my understanding wrong?
No, and I think, yourselves and Linda, as quite a few others on the line, are retired, and thinking about the portfolio to supplement their needs, and that's why really the bonds are already part of your investment portfolio, and just kind of the balancing act is how much to put in there. And I really, I think, as I was mentioning to Rick, and I think this is true for all of our clients who are retired, is just that balance that, yes, we like the stability of the bonds, we like that they're gaining some value right now, and they do need to be a part of the portfolio. And then just the flip side of that is, well, to what extent? Because right now, as we look at the bond environment and especially what's been happening these past few weeks, to lend the United States government money for 10 years, what we think is a nice, great, safe investment, which it is, the problem is they won't even pay you back 2% a year on it.
Yeah.
And the challenge is it's hard to make the retirement plans work with that kind of yield and just in this kind of environment. So what we try to do is to just put the stocks in the background. We know they're going to gyrate up and down, and we've had lots of up points over the past 5 or 6 years, and we've even had some over the past month, and we had some towards the end of last year. And to just always be alert to say, oh, well, when the market's up, can we sell? Can we replenish the bonds? Can we make sure that we're balancing out? And what I would just I always think of it as trying to make the stocks work for you instead of you working for them, so that you're not just on the yo-yo going up and down, but that we're always looking for chances to trim down the exposure when things get high. And honestly, just to be honest about it too, and just to be willing to increase exposure if prices get low. If prices get low for an irrational reason, again, if people are too focused in on something that's turns out to be a temporary issue, like the potential of the United States defaulting on its debt, something like that. If that creates a buying opportunity where it makes sense to add stocks, we want to be open to that and willing to do that, because we know that can actually help further your retirement goals, not slow them out, or endanger them.
Okay. I guess one question I have is how fast we react to that. When you see an opportunity, you don't want to just jump on it, because that's reacting to the market, and in every conversation we've ever had, you don't want to try and guess the market. So do you give it a couple of weeks and see if it's still there, or how?
Yeah, I would say, I mean, in general, I think it would make sense to wait for a significant move, because just the way we see happening day after day after day, where it goes up or down 300 points. So I was even saying to someone yesterday, oh, boy, the market's been up the past few days. Maybe I should sell stocks yesterday. And then what happens is the market goes down 300 points, and I ended up selling at a dumb point.
Yeah.
So just, the kind of the really, as long as it's oscillating around 300 points in a day, you're right. There's honestly nothing to do, because the market will just run away from what appears to be a short-term opportunity. And really, we don't care about short-term opportunities anyway. It's really just the long-term. And then, what ends up happening is when there are, major 20% gains, 20% losses, there is time to, to think clearly about that, and just to always look in terms of someone's individual situation, what's their asset allocation, and and what's going on in the world, and to try to make a reasoned decision based on all those factors. But I totally agree with you. To try to do something day by day, especially in this environment, it wouldn't work.
Right. Okay.
Nate, it's Stacy. Do you have any feelings about Congress potentially stepping in to try and stimulate economy through legislation like what was done in 2009?
Sure. Well, it definitely would not seem, based on how things are aligned right now, that there would be a major impetus, to be done with Republicans in Congress and elections coming up. One thing that did sort of fly under the radar a little bit towards the end of last year, where there was a mini celebration in Washington that they resolved the budget for a couple of years, which actually is great news, of course. But really, the way they resolved that they made everybody happy, was that they cut taxes and increased spending. So that usually makes people happy. So they did put a little stimulus in towards the end of last year, and as always, we'll just have to see if that really matters, because some of the spending are probably into things that maybe aren't that productive. But I would say right now, especially because although the GDP bounces up and down by a little bit, basically it ain't broken. The economy's growing. It's whatever the rate is, 2%, 2.5%. It's not bad. There's no inflation, and 250,000 people are finding jobs every month. So it's hard to imagine that there would be a big groundswell for a big program, a jobs program, or a tax-cutting program. I guess we will see, because if you look, some of the platforms from the presidential candidates definitely promise tax cuts. That would be a pretty big shot in the arm, I guess, if they didn't bankrupt us. So it's sort of hard to even imagine those things coming into effect in January, but that is certainly on the platform of quite a few of the candidates, or some major spending and tax-cutting programs. But probably between now and November, I don't foresee anything on that front. Did anyone else have any thoughts or questions?
Thank you very much.
Sure, that's fabulous. And like I said, we will be, excluding my greetings in the beginning of the call, we'll be, recording it and posting it on the site. And because I know we have quite a few people who wanted to attend and didn't, and if there's anyone that that thinks might be interested in this, please feel free to pass it on. And in the meantime,